Welcome back to the course, The State of the United States Economy and Society. This is part 7. And in this part, we'll deal with the ownership of property. During the 1950s, U.S. residential property markets were defined by a massive post-World War II building boom and the rapid rise of suburbanization, with over 11 million homes built during the decade, many funded by the VA and FHA loans. The era popularized affordable ranch-style, split-level, and mid-century modern homes, often under 1,000 square feet. The median home price in 1950 was roughly $7,354, or about $97,740 in 2026 inflation-adjusted dollars. At the same time, housing for Black Americans and other minorities was defined by a dual system of government-sanctioned segregation, exclusion from the burgeoning suburbs, and confinement to deteriorating urban centers or segregated public housing. The ownership of a residential property was almost taken for granted by a majority of white Americans who reached adulthood in the 1950s, their children who entered the workforce in the 1970s, and even their grandchildren who came of age in the 1990s. However, with each passing year, and despite a significant property market crash in 2008, property prices in 2025 were out of the reach of an increasing percentage of young people reaching adulthood. Many others whose incomes have not kept pace are having difficulty just keeping up with rising rental charges. What is not widely understood is that the crash of the nation's property markets in 2007-2008 has had long-lasting consequences, unevenly distributed across the United States. It will be useful to look at the history going back to the 1950s. Beginning in the 1950s, millions of young adults left the nation's cities to live in new suburban communities characterized by affordable, single-family detached housing on a small piece of land. Millions of veterans had access to mortgage loans because of the guarantee to banks by the Veterans Administration. Others who met the income eligibility criteria were also to obtain financing because of guarantees by the Federal Housing Administration. From that time on, residential property markets have been a key driver of the U.S. economy. Consider the long list of participants in the housing sector, from landowners and building contractors to the retail sellers of everything required to make a house a home, to landscaping services and companies who service a home's key systems and equipment. The darker side of our financial system is evidenced by the millions of households who since 2008 have lost the properties they lived in, sometimes after many years of occupancy. Foreclosure filings, default notices, scheduled auctions, and bank repossessions were reported on 367,460 U.S. properties in 2025, up 14% from 2024. States that saw the greatest number of foreclosure starts in 2025 include Texas, 37,250, Florida, 34,336, California, 29,777, Illinois, 15,010, and New York, 13,664. Natural disasters drove mortgage delinquencies in November 2024 to their highest level in 3 years. Some 2 million mortgagors, that is borrowers, were 30 days or more delinquent on their mortgage payments. 3 hurricanes are cited as the cause of 61,000 delinquencies. Of the total delinquencies, 512,000 are seriously delinquent, meaning they are 90 days or more past due. Foreclosure proceedings was started in November on 21,000 properties. In response to the disastrous California fires, Fannie Mae and Freddie Mac announced on January 10, 2025, a mortgage assistance and relief plan that would grant to eligible property owners a 12-month forbearance without incurring late fees. Property owners had to continue to pay their property taxes, however. For properties with the housing unit destroyed, the county collected taxes only on the land value. In 2024 and 2025, wildfires in California destroyed more than 18,000 structures in total, valued at around $350 billion, with the vast majority of losses occurring during a historic series of conflagrations in January 2025. A side effect of the wildfire and other natural disaster losses is the rise in property insurance premiums, driven by increased disaster frequency. Research shows a $500 annual premium increase correlates with a 20% rise in mortgage delinquencies. The general delinquency trend has been upward since 2022. TransUnion projects the U.S. mortgage delinquency rate to reach 1.65% by the end of 2026, a modest rise from 1.54% at the end of 2025. In the fourth quarter of 2025, the homeownership rate in the United States was 64.8%. The chief economist at Realtor.com, Danielle Hale, believes the rate of property ownership will continue to fall during 2026 as potential first-time homebuyers will opt to rent to take advantage of falling rents in many markets. We should not be surprised by the much lower rate of homeownership for property owners aged 35 and under. First-time buyers have had the challenge of accumulating savings toward a cash down payment and to cover closing costs while absorbing increasing rental charges. A November 2025 report issued by the National Association of Realtors indicates that the median age of first-time buyers rose to 40 from 38 in 2024. Mid-2025 data from the Census and ATTOM reported a slight increase to 40.3% of households more than 35 million who own their residential property free and clear. Two-thirds of all mortgage-free homeowners are over the age of 60. For those who have owned their residential property for any length of time, the combination of loan amortization and rising land prices generates enormous equity. Now let's take a look at the aggregate picture. As of January 2026, the total value of all residential property in the United States is estimated to be $114.94 trillion. This figure is part of a broader real estate market projected to reach over $141 trillion by the end of 2026. Analysts hold widely different opinions over whether these prices can be sustained if mortgage interest rates increase. For some time now, there has been a shortage of available properties in many markets. The pandemic, inflation, current owners aging in place, rising land costs to developers, and community resistance to higher density development have all contributed. U.S. households originated $1.40 trillion in new mortgage debt through the first 3 quarters of 2025. 80.1% was issued to super prime borrowers with credit scores of at least 720, while 4.2% was issued to subprime borrowers with scores below 620. This chart shows that despite seasonal volatility and the effects of other factors such as regional economic changes or increasing mortgage interest rates, a residential property has been a rather good investment, provided one is not forced to sell during the bottom of a cyclical downturn in the land market. Property assessments almost everywhere remain unchanged for many years, which also results in windfall gains for those owners whose properties have increased the most each year. But then there are these affordability challenges. Let's take a look. One of the serious challenges for communities looking to increase the supply of affordable housing is, of course, acquiring land at a price that allows affordable housing units to be constructed. The problem is not universal, however. Many cities have large quantities of land that can be offered to developers at below private market prices in return for a commitment to construct affordable housing. In 2014, the city of Chicago began selling city-owned lots for $1 to local property owners who committed to developing lots with new housing units. As of October 2018, nearly 2,000 lots had been sold out of some 32,000 vacant lots. In 2022, the program was revised to price the remaining lots for at least 10% of market value. Cities often decide to raise cash by selling off prime publicly owned locations. A much better long-term option, I argue, is to offer the land under a leasehold arrangement that allows for increases in the ground rent payments as market circumstances warrant. This list of the markets that experienced the highest percentage increases in property prices during 2014 tells a great story. This indicates that many people are deciding to relocate to places where housing remains affordable. Some are able to take their gains by selling in a high-cost market, purchase a property elsewhere, and still have a considerable net gain. While labor, materials costs, and government fees can differ to some extent location to location, the fundamental reason for the huge difference in the asking price for a residential property is the cost of land. Current data is not available, however. For example, in Colorado, residential land prices rose 174% between 2012 and 2022, about 6 times the pace of overall inflation. The average cost of an acre of land in 2025 was $942,200. Hawaii had the most expensive residential land of any state at an estimated value per acre of $3.49 million, with Honolulu being the most expensive urban area in the state. California was next at $3.3 million, with Manhattan Beach carrying the highest value. New York was third at $2.98 million per acre, with Brooklyn having the highest residential land values. In California, the median price of a residential property is $700,000, which is more than 7 times the median income. 1 in 3 listings are priced at more than $1 million. One result is that nearly 1 in 4 of the U.S. homeless population resides in California. Another result is that nearly 1 million people left California for Texas between 2009 and 2025. Forecasts for 2026 suggest there will be price reductions in response to an increase of properties offered for sale. With median property prices in California double that of many other parts of the country, there has been an exodus of people and businesses. Statistics provided by the California Department of Finance indicate that the net loss of residents from 2015 through 2023 was around 731,000. During 2025, California saw a net loss of approximately 260,000 residents to other U.S. states. This was a significant widening of the exodus compared to the 140,000 net loss recording in 2024. The cost of a residential property is only one, but also a major factor for calculating the cost of living in a city or its extended metropolitan area. The percentage of properties that change ownership in a given year is small. When market prices have been increasing over time, sellers experience significant gains. As already observed, renters have the least control over their housing costs and experience the most difficulty qualifying to purchase a property. Other factors include local taxes, utility costs, costs of child care, insurance premiums, and the cost of food. The city of Philadelphia has been experiencing a construction boom since before the COVID-19 pandemic. There have also been extensive renovations of historic buildings. Demand has been fueled by higher income millennials, by New Yorkers seeking to take advantage of Philadelphia's lower residential property costs, and by empty nesters leaving the suburbs. 20 projects were completed in 2024, and there are over 30 more underway. 43 out of 53 of these projects have residential components. Many small towns across the United States are losing population, particularly of younger adults. Some, such as Marquette, Kansas, will give new arrivals a building lot for free. What is happening in Detroit is a clear sign that the city is recovering from a long period of disinvestment. In November 2024, the median price of a property in the city of Detroit was $87,500, still very affordable, but a 16.7% increase from the previous year. By April of 2025, the median sale price had increased to $109,000. The mayor of Detroit reported in October 2024 that $1 billion had been invested in the construction of 4,600 affordable housing units between 2019 and 2024. As population growth and new household formation has increased the demand for land and housing in many suburban regions, older existing houses are often purchased by developers who tear them down and build much larger homes, or obtain approval to subdivide the lot to construct more than one home. From a public policy perspective, it is vital to consider the market for housing as separate and distinct from the market for the land on which the housing unit is constructed. The value of a house is its replacement cost less what depreciation the house has experienced. The difference between this value and the total price for the property is the value of the location, a value determined by factors outside whatever improvement exists, a value largely associated with the quality of public goods and services brought to the location. The very same housing unit will, as we know, have a significantly different selling price depending on the neighborhood and the community. So let's move on to the next subject, which is going to be, now we will examine the widening gaps in income and wealth.